Hey traders, Raghee here. Welcome to Charts and Coffee. Hope everyone is having a good Tuesday morning. We have some data that is already affecting price action. So if you're not taking a look at your hot zones, what are hot zones? Hot zones are simply the myriad of scheduled high impact events that we have. They could be macroeconomic releases, they could be earnings, they could be Fed speeches. They are all simply high impact events, but they have to be scheduled, right? If we don't know they're coming, it's on a hot zone. So if you take a look at what we have for today, Thursday, advanced GDP and unemployment claims, is GDP as important a metric as it once was? It really isn't. And I would have to say, I would particularly point to Jerome Powell and this particular group, or at least this ongoing group of his voting members as he's been Fed chair. They have ignored sequential negative GDP quarters and really just sort of ignored the fact that that has been one of the definitions throughout my career anyways, past 30 plus years, of a recession. And they pretty much blew that off. So GDP really becomes this thing where it's good to know the output of a country, but what does it mean to the Federal Reserve? And Jerome Powell has basically proven doesn't mean a whole heck of a lot. They are prioritizing, and in fairness to them, they actually have a dual mandate. And nowhere in that dual mandate, that their checklist of things to take care of, is growth. That's not their job. Their job is basically self imposed inflation, their inflation target, and employment. So this is one of the rare central banks of I think all the G8 countries that has a dual mandate of both inflation and something else, in this case, employment. And so, GDP becomes this sort of meh thing that we know we're supposed to kind of care about, but we're not so sure why anymore. So let's see if anybody does care, because at the end of the day, whether it's important, whether it's not, price action, everything we know and frankly don't know about any symbol, price will tell us if it's good or bad. I'm not going to look at GDP numbers to say they're good or bad. I'm going to look at how bonds react, dollar reacts, equities react. So let's take a look at the S&P here. Now, we had two hot zones. Typically, unemployment claims are not going to create this type of reaction. As you could see, when folks say, oh, we're selling off into the morning, it is because of the hot zone. It looks to be largely GDP. Look at the time, look at the reaction. That's all that matters. Now, the way to then take it to another level would be to look at bonds. This is telling a much bigger story. And this is the story that we want to know. Is the Federal Reserve going to or not going to cut rates? Is good news bearish or is bad news bearish? Where are we? And you can see here, 8:30 yields started moving lower. And that means, bonds started moving lower, which means yields started moving higher. I know it's inverse. So when ZB moves lower, when TLT moves lower, that actually means that the rates are moving higher. And that's what we have here. Now you might say, Rog, well, then what's the reaction at the target rate level? We still have one more, far more important metric to come, far more important than GDP, far more important than unemployment claims, and that's tomorrow's PCE. And that will likely set the tone for the end of this week and likely set the tone going into the next FOMC meeting. You can see here, June, once we exceed 80% probability on these target rates, that's pretty much, quote unquote, fully discounted. Are we ever going to know what's fully discounted? That cracks me up when people say that. I mean, there is that lingo, but I never know what every human on the planet is going to think or do based on data. So I have found once Pareto principle, I guess, once it's about 80%, that's about as heavily discounted, fully discounted as we can get. 88%, we're going to, again, largely hold in July as well, it looks like. So June's a hold. By the way, May is no question. May is darn near 100%, right? June, July, hold. And this is where the ongoing struggle continues. Are we or are we not going to cut? Now, remember, here's what's so hilarious. A lot of folks said, Rog, what if they don't cut? Okay, here's what I want everyone to remember. When there was expectation for the Fed to cut rates as soon as March. And that was back in October, November of last year. What did we talk about day in and day out in Charts and Coffee? Please drink some nice coffee. Please buy the dip. And that worked for almost 6 months. October, November, December, definitely November through December, January, February, March, April 4, things changed. It doesn't matter what's real. We trade we trade perception. There's a guy on YouTube who's talking about what a secret power is. What is a secret power? Perspective, right? Perspective versus perception. Go Google that. I think his name is Andrew Bustamante, and he's been out there talking about when people say, "Oh, he was a CIA agent, by the way, he was a spy," and they say, "What's a super secret spy weapon?" And he said, "Perception versus perspective," and that is still what the market moves on. Market moves on perception. What do the broadest group of people believe the Federal Reserve is going to do, or rates are going to do, or earnings are going to do? Whatever it is, that's perception. Yet most people talk about perspective. What do I think? And as I like to remind myself, nobody cares what I think. The market doesn't care what I think, right? It's only what I see. It's only what the data says. Perception versus perspective, right? And those folks who are top picking the entire last, 5 months, again, that November to end of March, right? What is that? That's perspective. I think the Federal Reserve doesn't know what's going to happen. I think this is too high. That doesn't make you money. So if the perception right now is they may not cut, well, we'll have to change the way we look at price action and take advantage of different kinds of moves. That's all, right? It's always very much a perception game. By the way, what do you get on television? That nonsense is all perspective, right? That's why it doesn't help. That's why, in fact, worse, it's the opposite of help. Okay, so this is what we've got going on here this morning. Will I look at my gauges? Will I look at my indicators and say we're still in chop? Yes. I mean, let's face it. If I look at this 5-minute chart, it's really easy to get carried away and say, oh my gosh, the market's tanking. Again, perception versus perspective. Here we go. If you want some perspective and you're saying, Rog, I need to at least have some sort of bearing for myself. Sure. Trust your gauges. The gauges are unemotional. Your indicators don't care if it's bullish or bearish. They're not trying to please you, right? They don't have bias to want to get into a trade or for a certain stock to rally. Things are what they are. We are starting to see the very early stages. Again, this would be my indicator's perspective of some more weakness. If we continue lower and there's more bearish chatter, more chatter about the Federal Reserve not cutting, again, perception could be changing. But for now, this is still not taking out the April 19 low. We're still looking at a fairly choppy, but arguably far more bearish than we've seen in a long time. Look at the NASDAQ. And how do we know that? And is that because of today? Gosh, no. That started, again, on the 15th. The chop started on the 4th. The VIX got above 16 and stayed above 16 since the 4th. And by the way, where is the VIX today? And I've been talking a lot about how important it is. On Tuesday, I showed you all what has to happen, right? What has to happen in order to get some more normal action, maybe some stability, maybe some bullishness. We have to stay above the anchored VWAP, the first trading day of the year, anchored VWAP on ideally the S&P, because remember, VIX is a SPX options metric. And the VIX has to stay at or below 16. So those are things that if they don't hold that expectation, we have to know the conditions, right, under which we can trade an environment a certain way. So if we're diving back below the VIX, this is exactly what we talked about on Tuesday. What are those levels? What are those lines of the sand that if crossed is a different environment? In this case, getting back down below that anchored volume weighted average price and getting back above 16. That changes what it is we're going to expect. All right. So as always, gang, feel free to type any questions that you may have. And let's see what we've got here. IBM. Let's go take a look at IBM. Hey there, Carmen. Yeah, IBM is interesting. We've got the earnings coming out on IBM. We're trading at 165. Obviously, Well, here's what's interesting about IBM, Carmen. The trend in IBM has been bearish since the 18th. Isn't that interesting? And the momentum's been bearish since the 2nd. So is this a continuation of what was already underway? We could arguably say yes, right? But yeah, IBM, definitely not something I would be bullish into earnings. Yeah, not that I play earnings at all, right? So next up is Bank of America. Bank of America is sitting at $37, which is not really a major problem because 37.89, where we sit right now, is inside potentially the daily price movement range. We'll see where the daily price movement range plots in 18 minutes, because at 9:30, boom, I'm going to get my new DPMRs. But it could be interesting. Not that Bank of America is in an uptrend, but this may not be as bad in terms of movement lower. Now, when I say bad, bad is anytime we transition structure, right? That's always difficult. If we're moving one way and we move another way, I don't care what part in life it is, it's always going to be an adapt. We have to adapt to it, right? So how do we adapt to this? If the pullback can stay with green candles, which looks like it should, if the pullback can stay within the daily price movement ranges or even the standard deviations, which looks like it should, and we continue to move in a sideways market, not too bad. But here's a challenge. Also with Bank of America, neutral environment, this is an overbought. This is an overbought secret squiggle. So it was toppy going into earnings anyway, but there might be opportunity. There might be opportunity. All right. AKM, Acumen, AKM. No. Yeah. Akamai. Oh, there it is. AKAM. All right. Red candles, downtrend. Yeah, this is nothing but bearish. I don't play Akamai. It's not necessarily something that's weighted in the broader averages, but it does look like a very nice trend. Yeah, Alice, it looks like a very nice trend. What do I like about it? It's below the 200. It's got, oh my gosh, red candles for miles. We've been seeing nothing but red candles since the previous earnings. And once we cross the 200, once we cross this equator, the white dots, we continue to move lower. Mean reversions, I would focus on the short side. Sure. All right. Next up, so we took a look at Bank of America, took a look at IBM, took a look at AKAM, mRNA. Sure. mRNA. There we go. All right, mRNA. Well, this looks like one that, if you asked me last week, it's not that different than what it was before, which is still in a choppy environment. It's been in chop since the 5th. The closer we get to that lower quarter. So what I would have done, and I'm sure we would have talked about it in this way, is the half of half, right? When you've got a range, cut the range in half, and then cut the half in half, right? So now you've got your lower quarter. Another thing you can do if you wanted to is, if you are a little bit more adroit on Fibos, right? Just activate the 236 and the 50. And then when you do this, so what was our last major move that we're looking to see retraced? Just like that. And that's all we would look. That's one way to look at it. All right. So in that lower quarter, if you want to be a buyer, that's the place to do it. In that lower quarter, right? That would be the place to do it. So again, if you want to look at any range, and you're comfortable pulling Fibonacci's from the last major move. Look, Fibonacci is just a mathematical reality of nature, right? So if you want to do that, then I would say just, there we go. Just put in that 236, right? So the last major move that we're retracing is this one. That move lower. And that's what I look for. And so once we get down to 101.40, that's your lower quarter. Anything below 101.40 to the Darvis. And notice I used the Darvis minor low to minor high to say, all right, there it is. There's the Fibonacci retracement. Fibonacci is interesting, but it's extremely subjective. It's not the main tool that I use for, frankly, anything, but it is good if you have a process for drawing Fibonacci. And you'll notice what I've done to make it more process driven is I use my Darvis. I use my minor highs and minor lows. So there's a consistency in the way that they're pulled. All right. So yes, it's bouncing from that quarter of the quarter. It's bouncing from that lower part of that range. And that's where ideally you would find what we did have, which is a secret squiggle down near the low. So that's a pretty good look right there. All right, next up is, let's see here. Hang on, let me scroll through. MRCK. All right. MRCK? MRK? MRK, you mean? Okay, anyways, let's do MRK because I don't know what MRCK is. But anyways, so Mark has good earnings. Yeah, we're trading up at 130. Is at one to buy a pullback on a day trade? Green eggs and ham, I'd have to have the bell ring. That's not going to happen for 13 minutes. And I'd have to have a setup. Is it one that would be a contender? Sure, because what we're going to find this morning is it's trading above the previous session close. It is largely bullish, right? No question about it. And so with that in mind, be careful. I'm not a big fan of trading stocks into earnings or even immediately after earnings. I'm not a big fan of that. However, if we can continue to plot green candles, if we can continue to trade in a way that's supported above the mean reversion on the 5-minute chart, if we can stay above even, say, points of control, anchored VWAPs, all those different lines in the sand, yeah, I would definitely keep that in mind. Yes. All right. Yeah, MRK, thanks. Thanks, Green Eggs and Ham. All right. XLE. I like XLE as long as I like crude. So the question is always, do I like crude? And this connection is going to be the same for copper to, say, metals and mining and silver. It's going to be the same thing with gold to gold miners, crude to oil services, crude to energy, crude to oil and gas production. So if I like crude, then I like those. Let's be careful. Crude's been a little tricky the last handful of sessions. I do like XLE. Remember, we do have Exxon and Chevron earnings coming up. But largely speaking, I do want to be long XLE, nothing but green candles. Those are bullish candles. And we have been holding pretty well above the daily price movement range. But be careful here. Again, crude oil's been lumpy bumpy, and Chevron and Exxon are coming up. But yes, I do like the way in which XLE is moving. And I believe the same could be said for XOP. So take a look at some of the individual stocks within those sectors, Dave. And then make sure you're not, wandering into an earnings environment, especially Chevron, Exxon, or ConocoPhillips. Those are the top 3 weighted names in the XLE. All right, gang. As always, thank you so much for being here for Charts and Coffee. I will see you all tomorrow, same time, same station.